This is Melanesian Women Today, and in this video we're going to talk about loans. I think a lot of businesses eventually find themselves in a situation where they could use a little more money, because if they had more money they could do something with their business that would create or allow them to earn even more money, making their business more successful. So one of the ways you can do that is by taking out a loan. So in this video, we're going to simply focus on the loans that come from banks. And loans that come from banks basically work, and always have worked, in the same way. So the way it works is that the bank will loan you some money. That amount is called the principal of the loan. So that is the amount that you actually borrow, that the bank actually gives you. They have long processes for this. They have paperwork to fill out. They might ask for collateral, which means something of value that you could allow the bank to take if you can't repay your loan. You have to talk to your local bank about that. And because the bank doesn't just give you money for free, the bank then charges you interest. And the interest rate will always be in a percent. So a great interest rate would be very low, like 3%. A very bad interest rate would be sometimes as high as 20%. We want to stay away from things like that. That's very expensive. And what happens is the bank then, every month, you make a payment, and that payment does two things. It pays off part of the principal, so you're paying off part of the loan that you borrowed, and it pays for interest. So your whole payment doesn't go towards the money that you borrowed. Part of it does, and part of it goes for interest. One of the most important things that you can do when you're looking at a loan is seeing how expensive it is. So what you do is you take a look at your monthly payment and you multiply that by how many months you have to make that payment, and that will be your total cost of your loan. So let's say that you borrowed 1,000. We'll just use dollars. It doesn't have to be from a country, but we'll just say dollars. And your payment each month is $100. So you borrowed 1,000. That's what you borrowed to start with. And your payment each month was $100. Now, let's say you had to make that payment for 12 months, so that'd be 1 year. So that means the total amount that you're paying back to the bank is $1,200. And wait a minute, you only borrowed 1,000. What's the extra 200? That's the interest that you pay to the bank. So in order to borrow that $1,000, it will cost you $200 over the course of that year to repay the bank. So if that amount of money is worth it to you, then that loan is a good deal. If you feel like that loan is too expensive, then you should not take that loan. So when it comes to loans, please make sure that you are aware of your interest rate, and then even more importantly, calculate what that total cost would be. Make sure that that total cost is worth it to you, that you feel like your business could be that successful and cover the cost of that. And that's it for loans.